Historic and technical events are unfolding as the tectonic plates of the financial world shift. Many assumptions about gold miners' correlation with the stock market have been challenged over the past 2 years, leaving many in the sector feeling either bored or fearful, convinced that prices will never rise again. However, these shifts often take time, and it seems we are now on the brink of rapid changes that could surpass anything we've witnessed in years, if not ever. This isn't a promotional pitch. Rather, it's an observation from my career that I've never encountered such a convergence of macroeconomic, technical, and fundamental factors that could significantly benefit gold, silver, and their miners. We are facing a monetary crisis that has been brewing for quite some time, particularly in the U.S., where central banks have inflated a massive bubble unlike any seen elsewhere, not in China or Europe. The stock market's performance since 2009 has been staggering, with the S&P rising 7-fold and the NASDAQ soaring 16-fold. When we examine historical bull market peaks that preceded major bear markets, such as in 1929 or during the dot-com bubble, the percentage gains leading up to those peaks pale in comparison to the extraordinary growth we've seen in the last dozen years. The underlying causes of this surge are clear when we analyze M2 and Fed funds charts over the past 2 decades. The remarkable rise of the S&P by 7 times and the NASDAQ by 16 can be traced back to the creation of a substantial and sustained influx of capital, which persisted for over a decade. This influx was not merely a temporary phenomenon. It was a deliberate effort to channel money into the economy. However, the definition of inflation has often been narrowly and inaccurately framed. Inflation should be understood as an increase in the quantity of money circulating, which inevitably finds its way into various sectors. Historical patterns reveal that such monetary policies can lead to significant investments in the stock market, as seen in 2009 when the S&P plummeted from 1570 to the 600 ES, prompting investors to see a low-risk opportunity. Yet, the late 1970 S tell a different story, where despite a similar influx, gold and silver surged while stocks languished until 1982. This illustrates that monetary flows can sometimes divert into unexpected areas, and many asset managers, including prominent figures, are now advising investors to focus less on stock prices and more on the diminishing value of currency. They argue that gold is becoming increasingly attractive, suggesting we may be on the cusp of a new bull market that has been building since the lows of 2015, a trend that can be observed in gold's performance over the past 50 years. To provide some context, there have been 3 significant bull markets in gold over the past 50 years. The first began in the early 1970s and peaked in 1975, when gold was legalized, witnessing a remarkable surge from around $30 to $200, marking a 7-fold increase. Following that, from 1976 to 1980, gold skyrocketed from $13 to $850, achieving an 8-fold rise. The most recent bull market started in 1999, with gold priced at approximately $250 an ounce, climbing to nearly $1,920 by 2011, which also represents an 8-fold increase. Over these 50 years, gold has consistently delivered these substantial returns, making the current market movement, which has only seen a doubling from the intraday low of $1,046 in December 2015, seem relatively modest in comparison to previous bull runs. The current landscape is fraught with monetary uncertainties, as many institutions that have relied on flawed investment strategies and misguided assumptions about the cost of money are now facing the consequences of their errors. As these mistakes come to light and institutions begin to falter, the prevailing belief that the Federal Reserve is the guiding force may be challenged. This could lead to a significant shift in perspective, prompting discussions and potential actions regarding the necessity of central banks, with a growing sentiment that perhaps money should be allowed to find its own value. The idea of treating certain commodities like eggs, beef, grains, or chips in a free market could become a reality, especially in the wake of an economic collapse. Observers are already noting a shift among some economists, particularly those who typically support the Federal Reserve, as they begin to voice concerns about the Fed's actions. These economists, who once stood firmly behind the central bank, are now suggesting that the Fed has overstepped its bounds, continuing its policies even when warnings were issued. This growing skepticism is noteworthy, as even those who have historically been allies of the Fed are starting to express doubt. It's not surprising that such events could lead to a re-evaluation of the system, prompting questions about the effectiveness of a century marked by cycles of boom and bust. We are witnessing what could be the largest economic boom, followed by an unprecedented bust in U.S. history, with significant repercussions. Our perspective is that once these asset bubbles encompassing municipal bonds, high-yield corporate debt, and stock prices burst, we will likely see a decline in the dollar as well. This impending wave of change suggests that traditional investment options may soon dwindle, leading to a shift towards monetary metals as a response to the emerging monetary crisis. The central banks have a significant role in shaping financial markets, and history indicates that when the market begins to falter, particularly after a major bull market peak, the Federal Reserve often reacts by lowering interest rates. However, a closer examination of the relationship between the Fed's interest rates and the S&P 500 reveals that this strategy tends to be ineffective in the immediate aftermath. By the time rates are reduced, the stock market has already begun its decline. This delay means that any potential benefits from lower rates may not be felt until a year or two later, as the initial influx of capital often finds its way into other investments. The staggering growth of the S&P over the past decade, alongside the even more impressive rise of the Nasdaq, highlights the unprecedented nature of this bull market, which stands in stark contrast to historical peaks during previous monetary cycles. The allure of traditional money, which has been valued for millennia, is likely to surge if rumors of instability arise, especially given the interconnectedness of major brokers and banks. While many may feel reassured by the notion that these brokers would be absorbed by larger banks in times of trouble, it's a concern that many individuals have not had to consider before, particularly those with significant sums in their bank accounts, exceeding the insured limits. It's essential to consider moving some funds to different banks, especially if you find yourself with a substantial amount, like $2 million. In such cases, diversifying across 10 banks might be prudent, or perhaps a simple phone call to invest in gold could be a viable option. This thought has likely crossed many minds as they reassess their insurance protection in bank accounts, especially regarding gold, which may not have been on their radar for some time. Interestingly, Americans tend to be less enthusiastic about gold compared to investors in other countries. If the American market suddenly decides to embrace gold, it could lead to significant changes, given that both gold and silver markets are relatively small, and mining stocks represent an even smaller sector. The potential for a rapid shift in perception could be dramatic, especially as people notice that these assets are performing well, despite the Federal Reserve's efforts to combat inflation, which they often link to commodities. We identified a coming commodity explosion back in October 2020, when the Bloomberg Commodity Index was just above 70, having previously dipped into the high 50 tech. To put this in perspective, during its bull market peaks in 2008 and 2011, the index soared above 200, indicating a significant deflationary period. Notably, while gold prices surged from $1,000 to $2,000 between late 2015 and 2020, the Bloomberg Commodity Index continued to decline until late 2020, only beginning to rise after gold had already doubled in value.